A debt ceiling deal is on the table, and markets are relieved that the spectre of a US default has been put off for at least a few more months. Here in New York, the S&P 500 has closed the day up 1.4%. Treasury bill yields are back down in the teens, and the 10-year Treasury yield has dropped down to 2.66%. One big difference between today and the debt ceiling battle we saw back in July, August of 2011 is that the S&P has been very resilient. Indeed, at 1721, it's just a few points away from its record close in mid-September. Such resilience, however, means a debt ceiling deal is unlikely to produce equity market fireworks, so further equity gains will depend on economic data and earnings guidance. Attention now focuses on whether the economy has suffered at all from the two-week government shutdown, and more importantly, whether the prospect of yet another fiscal battle early next year overshadows activity. During the early stages of the third quarter earnings season, company executives have not been sure about how the government shutdown will play out across the economy. That may change as we enter the busiest time of the reporting season next week. For now, the silver lining, say investors, is that any weakness in the economy and further rancor in Washington will likely keep the Federal Reserve fully engaged in buying bonds well into 2014. Keeping bond yields low for longer makes equities look more attractive. But it also entails a softer dollar, and it should ease some of the pressure we saw across emerging markets this summer. Already this month, Brazil's stock market, for example, is up 8.8% in dollar terms, a near fourfold gain on the S&P month to date. All told, the relief trade from Washington about punting the debt ceiling into next year may be more forcefully felt in emerging markets rather than here in the United States.
This has been a long, challenging few weeks for Congress and for the country.